What is a real estate syndication and how does that work?
The syndication is simply a structure, how a deal gets brought to market and raises capital.
What are the typically the management fees that someone can expect? Did you say 1 to 2%?
Yeah, 1 to 2% per year. And before we even let's go back. Before you even dive that, I would absolutely go to the real basic of the business proposition. So if you're taking a decent Class B type of property with existing cash flow and existing tenant base, and the area supports higher rents and you don't have to do heavy repositioning, those type of projects is basic fundamentals of a deal. Maybe a lot easier to execute versus, like you said, I'm picking up a property that is a heavy lift where you think you can raise the rent from $500 to $1,000, and it's a lot of work. So it's not just the numbers. You have to make sure that the business plan looks very realistic.
Hi, everybody. Jose Luis Morales here. Welcome back. Today, we've got a returning guest. His name is Big Mike. Today, he is going to be covering different syndication structures, and he's going to be explaining to us how syndications work and how they work from a person raising money and also how they work from a consumer's perspective. Welcome back to the show, Big Mike. How are you?
How are you, Jose Luis? Thank you very much for having me.
Good. So let's get right into it because I think by now a lot of the viewers know who you are since you're a returning guest. What is a real estate syndication and how does that work?
So real estate syndication, one of the simplest way to think about it, there's a one real estate investment. There's a one property that gets bought by a, let's just call it a partnership. And there are many investors or partners in the deal. Sometimes folks hear about investors being called limited partners, LPs, and then the party or folks who run the syndication, they're also known as the general partners, GPs. So normally, a general partner would find a real estate deal, may it be multifamily, and have a strategy to acquire the property, renovate it, increase rents, and then sell at some future point of time. The syndication is simply a structure, how a deal gets brought to market and raises capital. So it's basically a vehicle. So syndication implies that there are multiple investors and there is a security created. So what is a security? Well, your stocks and bonds on Wall Street are security. In real estate, security is basically a partnership that doesn't have one investor, it has many investors that participate. So simply syndication just means a deal where there are many investors and they invest into a most commonly known as unregistered security. So I know it's a lot of information here and I'm jumping into the technical details, but I just think of it as a partnership with many investors and a single asset that gets acquired.
Can anybody create a syndication and can anybody invest in a syndication?
Well, can anyone create a syndication? So yes, generally speaking, you don't have to be you don't have to be a citizen of the United States, but it is certainly, for sake of simplicity, I'm going to say a citizen of the United States. Yeah, I'm sure you can do it as a non-citizen. You have to be a U.S. person, what is known. So if you're a U.S. person, you can create, generally speaking, a U.S. syndication, right? There are other countries, there could be other syndications, and I'm not going to talk about that. But a U.S. person can generally create a U.S. syndication. They need to pass some level of background tests or some level of verification, but typically the attorneys that put it together have the fiduciary duty to do that. But assume at the moment that the background is clean, any person can create a syndication if they find a deal. And then on the other side, any U.S. citizen, typically, or non-U.S. citizen, a foreign citizen, green card holder or not, can invest in the U.S. syndication. So typically, there are, depending on the type of a deal, there are rules. Some syndications are offered only to folks who are known to be accredited investors. So if a syndication is launched through an offering that requires accreditation, then it's only available to accredited investors. So accredited investors are generally defined Typically, it's for the U.S. People, U.S. citizens, normally, who are have an income of at least 200,000 if they're single for the last 2 years, or 300,000 if they're married, or sorry, not and, but or have a net worth outside of their primary residence, not the home they live in, of at least $1 million. That's a general definition of accredited investor. So any accredited investor can pretty much invest into anything. If you are a non-accredited investor and there is a accredited investor offering, you cannot invest. Basically, the syndicator is not allowed to take capital from a non-accredited investor into an offering that is only for accredited investors. Does that make sense?
Yeah, yeah. And it sounds like the purpose is just to protect people that aren't as savvy as maybe somebody that is an accredited investor, basically.
Correct. That's the intention of that regulation, is to avoid for non-accredited, not very wealthy mom and pop investors, or whatever you want to call them, the folks who don't have the experience to make the decisions, to be taken advantage of into these private deals. That's why accreditation requirement comes in. And again, depending on the technical requirements, there are some offerings that are available to anyone. They're basically public offerings. If you can fog a mirror, you can invest. But there are offerings that are limited to only accredited investors.
And then what is the difference between a general partner and a limited partner as it relates to a real estate syndication?
Sure. So general partner typically is the principal of the deal, somebody who found the property, somebody who's going to operate the property, somebody who is going to manage the property. And they are active partners. And that's the best way to describe it. They are the responsible folks. They have the track record, the experience, and the responsibility to manage the project through its life cycle. Those are, generally speaking, called general partners. And limited partners are the investors. They don't take any responsibility in the operation of the property. All they do is provide capital. That's why they have they're limited partners, and they have limited responsibility. Typically, they don't have the same level of responsibility and legal liability as potentially general partners.
What about decision making? Do they both have the same right of decision making, or do the limited partners not have any control over the asset, or how is that structured?
Yeah, that's a great question. That's probably one of the most important questions for investors to understand. So limited partners, most of the times, have very limited also decision power and limited rights. Some deals, some syndications, and sometimes funds may have limited partners, give the limited partners ability to vote to replace a general partner or replace a manager. Sometimes, most of the times, they don't have that option. They're pretty much right along passive investors, and most syndicators don't even give them the right to vote themselves out. So a poor operator can basically put together a deal, market it well, and investors write the checks with no ability to do anything other than ride along with the general partner. If a general partner is a crook, an idiot, or just dishonest person, they can actually take advantage of the limited partners to a substantial extent. So, as a limited partner, one should be very careful picking and choosing who they invest with, because, like you said, there's going to be very little control clauses, very little abilities. They may have voting rights to vote on some issues, but very limited, very little ability to make any kind of decisions or impact the deal.
Why do you typically see people invest in syndications? Like, what is the benefit of somebody investing in a syndication versus maybe buying just the property themselves, maybe a smaller property?
Sure. So let me start with I have a concept that I've developed years back, which is called kind of basically a pyramid, an investment pyramid, how folks invest. You can invest on the very top of the pyramid is typically single owner, single deal. You own a property outright. Either you buy an investment house, your primary residence, you buy a commercial project, but it's a one owner, one asset. The one step below that is a partnership. When you have a few partners and essentially a single asset. So syndication is a form of that. And we'll talk about in a minute why invest in that. Below that, in that pyramid, there are single strategy funds. And the funds, again, they just have more diversification than a single syndication. And beyond that, there are diversified funds. So just basically 4 different investments that most folks see out there: diversified funds, single strategy funds, syndications or partnerships, and then single asset, single investing. So the reason folks invest in syndications is because they want to take advantage of some of the tax benefits of real estate, for example, depreciation. Also, they want to take advantage of a great project, have a strong upside, and at times they want to avoid active involvement. So plenty of folks just want to invest passively. So one of the considerations why would you consider writing a check into a syndication is because you have a great general partner, call them, or an operator or a sponsor, who you believe will do very well in the project. They found a great project. You know, like, and trust them. You like the syndicator. And then you want to be passive. You don't have the time to be an active partner. So the reason syndications are so attractive is because they can offer the same benefits as almost direct ownership. It's basically a form of a partnership, right? You're entering into the deal with partners, and you're putting your trust and faith in your dollars into the partners, general partners, who are going to operate the deal. But you benefit from the upside of the transaction in the form of receiving potentially preferred return, receiving tax benefits, receiving return of capital in the form of a refi, receiving substantial amount of the upside as the deal goes through its strategy and generates strong returns.
How can somebody vet like good syndicators? Because I know that there's a lot of syndicators who are really good marketers, meaning they're really good at marketing syndications and really good at raising capital. But this is brought to my attention that there's a difference between somebody who's a really good marketer and somebody who's a really good operator. So how do you actually do diligence to make sure that the syndicator or the person that is raising the money is a good operator or has a good track record of success?
Yeah, that's the holy grail question. That is the $1 billion question. I used to call it the $1 million question. Now I call it the $1 billion question. That's the most important question, right? It is hard. For sure, it is hard. This business, in my view, at least the way we invest, and just to be very clear, an investor's job to pick a deal is not any different than my job as a fund manager to pick a deal, because we invest in deals, and we have to go through the same process of vetting these operators, and it's hard. So normally we have to have a referral. Again, we're trying to accomplish critical step number 1: know, like, and trust of people who you're investing with. You're trying to get there first. Until you get there, you can't. No matter how attractive the deal, no matter how pretty these return figures look like, you can't invest with them. Especially you get a Facebook ad or a Google ad in front of you that says you're going to get 25% IRR or 30% IRR, or worse yet, something even bigger. Some very attractive, but you have no idea who these people who are marketing. And these ads, anybody who has dollars and can buy an ad, right? So the vetting process starts with know, like, and trust. To get to the know, like, and trust, in our experience, always starts with a referral. If we don't have a referral, how do we establish that connection? If there's no connection, we don't want to look at the deal. Honestly, the bright and shiny objects, the more the deals are marketed, I don't want to say the worse they are, but quite often there's some truth to that. Heavily marketed deals means they're spending a lot of money marketing those deals. Just means that they got to pay for it somehow. And the deals are not necessarily very attractive because they're marketed. Because if they were very attractive deals, that'd be a private conversation. But like, literally, this is how it works. The best deals are not necessarily heavily marketed. Now, it doesn't mean things don't get marketed at all. It just means that you have to go back to the basics. Can you get a referral chain? Somehow, get to know the principals. Now, if you've got soft referral or you heard about these folks and you don't really know them, do the research. Start researching, run a background check. Now, how can I run a background check? We can ask our attorney to run a background check. Like you could, before you do something with somebody, background check. What comes up? What luggage do they have, right? If they happen to have some issues with the SEC and bad behavior and previous deals, and you start finding a bunch of dirty laundry, and they say, well, there was a past life, some change, 2008 crash, so on and so forth. But if there's a lot of luggage, a lot of problems, that's an immediate potential red flag. You could still consider doing some business with them, but if they have red flags, you may decide to stay away, right? Some background check. Then you look at the history of the investments, and this is not easy because some deals have gone what is known as a full life cycle, and some have not. So when folks claim great returns, well, how many deals have you completed full life cycle? Meaning that you purchased the property and then you sold it and you got invested returns. It gets a little bit of information on that. Or if these deals, they operate some kind of, most of real estate deals, unfortunately, until they go full life cycle, you don't really know what the return figure is going to look like. The other very important consideration, how many of these deals have been through difficult times? Just kind of ask the questions. Have you gone through 2008 crisis? If not, okay, why not? And if things have been great the last couple of years, well, the last couple of years have been absolutely awesome, more than a couple of years, right? It's hard to go back and find a problem deal in the last few years. You certainly can. Other important questions to ask: how many deals have you done? How many deals have you had problems with? And if they tell you zero, zilch, to some degree, it is a red flag. I actually want to hear about a problem situation. Have you had a problem transaction? How have you solved the problem? So just getting a little bit of that flavor on who they are as people. Are they smooth marketing folks that you don't see a problem in their conversation? They just know how to sell you, or they're very real. And then I generally, if we establish the fact that if these folks have track record, they are referred, the background looks pretty clean. The next conversation, let's talk about the deal. Let's understand why is this a good type of an property. But your first question was about finding these folks and vetting them, and it is a series of questions, and it is something not easy to do. But certainly better to start with intelligent conversations and getting some level of referral. Referral helps a lot. The cold vetting is probably 100 times harder than a good referral. Mm-hmm. As strange as it sounds. So that's how I view the issue.
What are the different type of structures in syndication? So, and this is something that I'm having trouble with because I've invested in a couple syndications, but I have more or less just invested in the person, meaning I believe in the person that's running the syndication. I believe that they have good ethics. I believe that they're going to do the right thing. I basically have developed a certain level of trust with them. But I hear things like preferred return. I hear things like IRR, just different terms. And to be honest, I don't fully understand them. And that's one of the reasons I wanted to have you on the show. One, selfishly to learn about these things as I continue to invest in syndications, and the other one so that other people can understand them as well too. Do you mind maybe giving us a couple of examples of different structures, how somebody can structure a syndication, and maybe what the difference is, and maybe what to look out for as well too, like maybe like hidden costs that aren't as apparent to like a newbie syndication investor?
Sure. So first of all, some of these terms could be scary, and they shouldn't be. Like anything else in life, it just takes a little practice to get to know them. And what's really interesting is that as you go through the learning process, you will learn two ways. One is you spend more time researching this, and you'll invest in education. And two, you'll make the investments, and then you realize you could have done better. So you will learn from that. You either will learn from your own mistakes, or you will learn through investing through the education. So most equity deals, and again, you could invest. Let me start with the real basics. So you can have a syndication that is a debt syndication. So somebody's making a loan on a property. Just think of it hard money loan on a fix and flip project, a large hard money loan. and somebody loans $5 million on a deal, and then they say to investors, we're selling an offering that is debt offering. So you can invest with us, we'll pay you interest. And there are many investors that invest in a debt offering, and they just get paid a certain amount of interest. That's the simplest structure where the money is raised through a loan from investors. Every investor takes a little piece of the loan, and the total loan is $5 million. Everyone puts in $100,000, 50 investors. Before you know, that's a debt syndication, right? So those deals, typically the debt syndications just pay simple interest, and at some point they have maturity, and then they repay back. So that's easy to understand. You loan the money at 10% for 5 years, you're repaid back your principal, and then while the deal is active, you get paid 10% interest ongoing. That's a debt syndication. Now we go into equity syndication. So most of the deals are equity syndications. For example, there's a property gets bought for $20 million. There's a bank loan for $15 million, and investors put together $5 million equity investment. And the equity investment does have terms. You'll hear a very fancy term called preferred return. Preferred return is something that is important. Just want to differentiate between preferred return and a guaranteed return. Guaranteed return, called Bernie Madoff. Seriously, the guaranteed returns are very, very rare, and they typically something that you don't ever see in real estate, or I haven't seen deals with guaranteed returns. Who guarantees it, right? And there's always a question of that. Most of the deals just have preferred return. Simply, it means that investors get paid first, a certain level of return. Now, it doesn't mean that the syndicator doesn't get paid ahead of investors. The preferred return is simply a term that just means that before profits are split, investors will get a certain percentage of the return before there's a profit share. So the easiest way to think, if a deal has 8% preferred return, what does it mean? It means that all fees aside, the property gets bought, and let's just say generates a certain amount of cash flow. And the cash flow is sufficient to cover 8% distributions to investors. So for sake of simplicity, investors would get that 8% before there's any profit split. If the deal had a profit split, could say once investors are paid 8% current preferred return, the profits are split, say 70-30, 70% to investors, 30% to the syndicator. Once every 8% pref is met, every dollar above that gets split 70-30. The reason the pref is important, it basically feeds a certain amount of return to investors ahead of the performance split. So if the deal doesn't generate at least 8% preferred return, then investors get paid first. If the deal generates 4%, but the preferred return is 8%, investors will just get 4%. Does that make sense?
Can you repeat that? So
one more time. So if a deal generates cash flow of 4%, right?
Uh-huh.
And the preferred return is 8%, investors will get paid first. They'll collect the 4%, and then but they're short 4%. The other 4% will get caught up later. So again, just explaining the terms on a high level. And let's go back. So before we get to the IRR discussion, I want to make sure folks understand the preferred returns just means that they get paid first. But if the deal doesn't support the payment, they're not going to get that distribution every year. What it means is they're first to get paid. The complexity comes in the form that these deals have the concept, what is known as a waterfall. So waterfall just describes who gets paid first, who gets paid second, who gets paid third, and so on. Without understanding that, it becomes difficult to understand the financial risks. So normally these deals pay preferred return. Let's just use an example, 8% preferred return. And then one term that folks should absolutely look for and make sure that it is cumulative preferred return. So cumulative means that if they're underpaid year one, it accumulates to be paid year two. In the example that I just gave, where the deal had 8% preferred return, but the cash flow only supported 4% distribution, the other 4% are not lost. It accumulates until the future years, right? Does that make sense?
Yeah.
Then
But question, Big Mike. If it doesn't say cumulative, does that mean it gets lost? Or if it doesn't say cumulative preferred return?
So if it doesn't say cumulative, you have to check with the syndicator and ask him the question: is this return cumulative? If you cannot pay 8% every year, will that be lost or will that be caught up upon a refi or a sale? That's
Perfect.
generally the key question. So if there's 8% preferred return, so I'll give you an example. Our growth fund, or some of the deals we do growth deals, they may have 8% cumulative return, but the expectation is immediately they won't be able to pay that. Why? Because it's a value add deal. It doesn't have enough cash flow. It doesn't mean it's a bad deal. It just means that there's just not enough cash to distribute. Confirm that's a cumulative preferred return. And if it's cumulative preferred return, that the syndicator or an operator or a sponsor will tell you, yes, it is cumulative. Wonderful. Because if it's not, it's something to think about. So most of the good deals have cumulative preferred return. After that, normally, the next step is return of capital you invested. What you want to hear that is that upon refinancing or upon sale or upon additional cash flow, let's just say the deal generates cash flow. So there's two structures, and I really, it'll take a while to describe, but imagine a situation where you have enough cash flow to pay the pref, 8% pref, right? What happens with every dollar after that on a good deal versus a different deal? So there are two types of deals. One deal, let's just say there's cash flow 10% on the deal. Then the other 2% that comes from the cash flow can go to investors to pay down their principal. So what it just means that investors get paid first. There are deals that'll say once the pref is paid, every dollar above that is split 70-30, for example, as I mentioned earlier. I'm not saying either one is bad, but they're just different. Really important structures. One always returns capital after the pref is paid. Another one starts to split immediately after the pref is paid. They're just a little bit different. But most normal deals where you buy a property or a syndicator does syndication, raises capital, they pay the pref first, then there is a return of capital. Any excess cash flow from operation or from refinance event or sale returns capital first. Once the capital is returned, at that point, investors should feel pretty good. At least they got their pref and they got the capital back. That's the good news. Now the really good news comes in. Then there is a split. And then the split just simply means that some amount of upside is going to go to investors and some amount of upside is going to go to the syndicator or the operator or the sponsor. And there are complexities in that and there are simple scenarios. So imagine a very simple scenario. 8% preferred return, full return of capital, and every dollar above that gets split 70-30. 70% goes to investors, 30% goes to the sponsor or the operator or the syndicator, whatever the term. So if a given deal generated an extra $1 million of profit to split, $700,000 will go to investors, $300,000 would go to the partners, so general partner or the operator. Mm-hmm. So that's the really basic concept. Now we go into IRR. So what the heck is an IRR? So IRR stands for internal rate of return. And it's a fancy term. And how do you do it? How do you compute it? Where it comes from? Well, it is a mathematical term. There's just no way to compute IRR other than in Excel. So Excel has a wonderful formula. And if you're not an Excel person, well, don't worry. You're going to have to find somebody who does Excel to be able to compute it, because without it, it becomes difficult to compute. But most of IRR is computed through a formula in Excel called XIRR. Literally, the function is Excel called XIRR. And it tracks when the money went in and when the money comes out and the dates. So if you invested today $100,000 in a deal, just using an example, it's just simple. It was a real simple. And the deal had some kind of a pref, and then it had a return of capital and a split. Imagine it was a growth deal. It was not a cash flow deal. This is the easiest way to think about it. And it had, say, using that waterfall, in 5 years, you doubled your money. How did that happen? Well, when on a point of a sale of the property in 5 years, there was enough money to pay you 8% pref for every year for 5 years, which would be 40%, right? So you would get 40%. So if you invested $100,000, you got $40,000 worth of preferred return, right? It's 40%. It's 8 times 5 years. Does that make sense so far?
Yeah. Mm-hmm.
Then you got your $100,000 back. That's your profit. Sorry, that's your principal back. You got your principal. So you received $40,000 of preferred return, $100,000 of principal. And then you received another $60,000 of a profit split. And the profit split, say, was, I don't know, for sake of the argument, 60-40, not 70-30, but 60-40. And that 60 represented, the $60,000 represented 60% of the upside. And then the sponsor received $40,000 as a profit split.
Mm-hmm.
So your total cash that you received is $100,000 of principal plus $40,000 of preferred return and $60,000 of performance upside split. Total $200,000. And it took 5 years, and you never saw a dollar in between. But you doubled your money in 5 years. What do you think? I'm going to let you guess. What do you think IRR on this deal is?
20%.
Not quite. 20% is what you think is an average non-compounded annual return. 5 years, double your money. That's the average annual return. Sometimes people use that number and they say, well, cash on cash is 20%. Your average annual return is 20%. These terms are sometimes misused. The IRR is the true number that actually tells you what is your internal rate of return. And the way to think of the IRR is to think of the average compounded annual return. The IRR on that deal is a little over 16%, 1/6. So imagine you if you got cash every year and you effectively got it every year, you would have received 16.some% versus the double, because it's compounding. Your 16% is compounding and compounding again, and that's what generates the average annual return of 20%. The contrast to that would be if you received cash on cash every year, 20%, and then you got your principal back in 5 years, but you didn't get any other upside. The IRR would be 20% because every year you got 20%. But because it's delayed, your IRR is lower. So the deals that have a lot of cash flow upfront, the IRR is generally higher because the IRR tracks when the cash comes out. All things being equal, again, you doubled your money, but how did you double it? Did you get cash earlier or did you get cash later? That's where IRR comes in.
And then what are the documents that you look for when analyzing? Like, I would imagine that all of this is presented in a form of documents. What documents are those that are being presented? And I obviously you look for a cumulative preferred return. Does it state the projected IRR as well too? And what other items does it have on there?
So we are still covering real basic terms of the high level. Every single deal that you're going to look out there, with rare exceptions, will have this stuff listed. And what documents listed? There's two possible documents. One is known as a PPM, Private Placement Memorandum. So PPM is typical for funds, but it also can be the document on syndications. The other thing that you see on how syndications are offered is through OM, Offering Memorandum. It's a very similar concept. PPM is just more of a technical term. OEM is just a simplified version of the PPM. So offering memorandum and private placement memorandums are generally how these things are offered. And they also will have a whole bunch of legal disclosures of what can go wrong. Everything can go wrong, typically is listed there. So it is something that investors are supposed to read and supposed to understand the risks. Most of this language is difficult to read, and it just says you can lose your money 100 different ways. Just be prepared. Honestly, it's a legal requirement, but there is plenty of legitimate, real risks disclosed, and if you don't pay attention, you can lose your money. And hey, listen, you should have read the document. But practically speaking, what you're looking for is a summary of terms. So most of the PPMs, private placement memorandum, they'll have either a component that sometimes you hear being called term sheet or summary of terms. And then on a offering memorandum on a syndication, same concept applies. So summary of terms will describe what is the preferred return And who gets paid next is the return of capital. Is it cumulative preferred return or not? The return of capital. And what is the performance split? And at times, there are also tiers that says, okay, it's 70-30 split after we return all the principal back. But until we get investors IRR of 12%. And once investors got an IRR of 12%, the 70-30 split becomes 60-40. And then when we get investors return of 16%, the split changes to 50-50. That these tiers, 12% or 15%, they're called IRR tiers. They're fancy terms. They just simply means that once the investors get to a certain level, what the syndicator says, I did such a good job, I got you that return, I deserve a little bit more upside. Does that make sense?
Yeah. Mm-hmm.
The other things that you really need to look for, and I look for quite a bit when we invest, is how is a syndicator or syndicators or operators or managers get paid? What fees do they collect up front? What fees do they collect as you go? And what fees do they collect on the back end? So typically you want to see alignment of interest. As much as possible, you want to see little fees up front, light fees as you go, and more fees on the back end align with your interests. Be careful when you see someone charging heavy acquisition fees. And the reason it's a concern is because they get paid up front, and if the deal goes bad, they still get paid, and your money may not come back. So what is reasonable these asset acquisition fees? And there's no right or wrong number. It really depends on how big the deal is and how attractive it is and how greedy or not greedy is the operator. On really big deals, 1% asset acquisition fee or less is fine. 1.5% is probably also pretty fine. 2% is sort of your standard, your norm. When folks run a multifamily syndication, 2% is like the most common number. I've seen 2.5%, I've seen 3% without it being, red flag yet. It all depends on how much work the sponsor had to do in a deal. The bigger the deal, the bigger is their compensation, the less percentage they can take. On a really small deal, they come in and say, hey, listen, I found this awesome deal, but I got to get paid 5% asset acquisition fee. Does that mean it's a bad deal? And they spend time and effort and they want 5%, and it may be justified. So there is no an absolute number. The range is 1% to 3%. That's the good range. The other fees that you're looking for is typically asset management fees. So asset management fees are the fees that get paid as they manage the asset. And there is no right or wrong number. What is the right asset management fee? And anywhere from 1% to 2% a year on the capital managed. So if they raise $5 million, not the whole deal. The deal is $20 million, but if they raise $5 million equity capital, between 1% and 2% is normal and common. Also, property management fees are appropriate. So if they're managing a property and they're collecting rent and they're operating, what are those fees? So making sure that all those things are not too outrageous is an important review step. What we usually request when we invest in a deal, we request a fancy spreadsheet called pro forma spreadsheet. The sponsor or the operator should absolutely have it. If they don't have a pro forma spreadsheet, how do they compute what the deal is going to generate in the returns? Because IRR formula cannot just be created out of thin air. It has to make some assumptions. So the pro forma spreadsheet typically demonstrates how IRR is calculated. So all these things are important, and we're going back to the offering memorandum. So offering memorandum will not have all the information as a pro forma spreadsheet, but you can ask for it. You could say, okay, I see the offering memorandum. You have a few of these terms. I'd love to see a pro forma spreadsheet. Now, what can you do with a pro forma spreadsheet if you've never used it before? Right? It may be good to have, but you're not going to be able to read it. I certainly can read it, and certainly we check the assumptions. The other assumptions that are in the performance spreadsheet is what are the rent increases? What are your projections? Some of the really important variables are in there. So as a passive investor, you may not dig into those details, but you do want to still ask those questions. What are the rent increase assumptions? and why do you think you can achieve them, and what kind of value add you're going to do. What is the investment, and why do you believe that that investment will increase the rent by the target amount? So just getting a little bit more justification into the assumptions, and after some level of experience investing in these projects, it'll be obvious to you whether these assumptions are aggressive or they are very conservative, and it is likely that the results can be easily achieved.
What are typically the and I love how you said the pro forma spreadsheet, because I would imagine if they are projecting a certain IRR or a certain type of return, if you have somewhat of experience, you can there may be red flags that come out, and it may be a project that you don't. Because if you look at an IRR and it says like 20-30%, whatever it says, it may look very attractive. But if they're assuming that they can raise the rents from $500 to $1,000 and the neighborhood only projects $800, then there's some things that aren't in line with reality. So I love how you said that. What are the typically the management fees that someone can expect? Did you say 1 to 2%?
Yeah, 1 to 2% per year. And before we even let's go back. Before you even dive that, I would absolutely go to the real basic of the business proposition. So if you're taking a decent Class B type of property with existing
Mm-hmm.
cash flow and existing tenant base, and the area supports higher rents, and you don't have to do heavy repositioning, those type of projects is basic fundamentals of a deal. Maybe a lot easier to execute versus, like you said, I'm picking up a property that is a heavy lift where you think you can raise the rent from $500 to $1,000, and it's a lot of work. So it's not just the numbers. You have to make sure that the business plan looks very realistic. Oh, you're buying this property in Detroit in a rough area, okay? Oh, you think you can increase the rent from $500 to $1,000 because you feel that there is enough data supporting that. That's wonderful. But how hard is it physically going to be there? Who's going to be in that area operating? Oh, you're an investor out of Phoenix and you're running a deal in Detroit. How practical is that plan, right? So some of those you have to do some real due diligence and to understand how the execution is going to be. Like, who's going to run the project, what the area looks like. Are you comfortable being in that area? Is this a war zone, or is this an area where you want to be? Theoretically, any plan could look wonderful on paper. Practically, you have to make sure that the business plan looks great, and then the pro forma looks great. So make sure you don't just underwrite purely based on paper, but you also have a pretty good feeling that the ability to execute the business plan is there. And back to your asset management fees, yes, 1 to 2% a year is normal and typical on these type of deals.
And then where do you find the business plan for the property?
Well, it's written in the offering memorandum or the PPM. It needs to say right at the beginning. It says we're acquiring 1,261 doors in Indianapolis, which is a project we just did, and it describes what is the strategy. And okay, we're planning to renovate this property and change the roofs, the siding, and then change the inside of each unit, installing the new appliances package, the new kitchenettes, the new carpeting, the new bathrooms, and we're going to spend so much dollars per unit on average. Typically these details are there, and it's going to take how long it's going to take. We're going to start June 1st, and it's going to take us 2.5 years to go through all the units at appropriate pace per month. And we have the contractors who can do this, and that's going to cost the following amount of money. Just the plan needs to be in the offering memorandum in substantial depth. So when you read it, you can actually say, yeah, that sounds reasonable, or ask a bunch of questions about the plan.
How do you find out how often they pay out the preferred return? Like, are most of them monthly? Are most of them quarterly? Are they mostly yearly? And are some of them just at the end on whenever they sell the property? And do most value add deals not pay monthly or quarterly because they're doing value add on the property, or how does that typically work?
So these are the great questions to ask, right? These are the questions you actually you try to read in the document, or you can ask the sponsor and operator. And at times, it's actually great to ask the questions, even if you read them in a document. And if they mismatch, if you ask the question, how often you pay, and they say monthly, and the document says that yearly,
What?
that's a problem, right? They don't either know what is written in the document, or they don't know the deal, or there's other issue. So in general, asking the questions doesn't hurt, even if it's in the document, because you're basically making sure that the operator and what their lawyer put together actually matches. So generally speaking, most syndications I've seen pay quarterly, but it is not something that you assume. You double check that. How often are the distributions? Or quarterly? Wonderful. And what do you project distributions going to look like? Year one, year two, year three, year four, year five. What I don't like is when they say, well, the average distribution is 10% a year. Well, that's great. If I hear the word average distribution 10% a year, I'm going to think first year I'm going to get 10%. Well, good luck with that. That's not a likely scenario. What's likely going to happen, your first year distribution may be 1 or 2%, and the next year becomes 6 or 7. And the third year after the refinance, it may become 12, and so on. So the point is, look at the projected distribution table. Sometimes it'll show you annual distributions, but it'll say distributions are quarterly, but the projection is annual. So for sure, get a good understanding what distribution timing is, and then likely amount you're going to get. And you should absolutely ask in the projections, this is a heavy value add project, what's the likelihood of actually receiving these distributions? Because the PPM language or the YOM language will say the operator or the sponsor may not distribute. That's that decision. So what I like to ask is, what is the realistic scenario? Even though you're putting that number down here, are you really planning to distribute? Under what circumstances will you distribute, or under what circumstances you will defer? And there's nothing fundamental wrong with deferral. If you are distributing, if the plan is to distribute 2-3%, that number is not really a big number. It's not going to make a material dent in the returns, especially if the target return is 17%. Okay? If I'm receiving 2%, is it really going to make any difference if I'm trying to make 17? No, it won't. So it's important to actually get a pretty good picture what the cash flow will look like, and is most of the return coming from a back-end sale versus a cash flow as is. On a value-add deals, it's heavily back-end sale. There are plenty of deals where you can actually see a good amount of return or good amount of IRR coming in as a cash flow. For example, if it's a strong performing industrial deal today, it might have starting yield 10% and its total return target 17. So you have 10 of 17 coming as a cash flow, and the other 7 on the back end in 5 years when they believe the building will sell.
Yeah. Good. Is there anything else, Big Mike, that you think would that investors or syndicators should know if somebody's maybe considering creating a syndication, or if somebody's considering investing in a syndication?
Well, there's a lot, right? Is there anything else? Yes. You want me to talk for the next 5 hours? Practically speaking, there are a lot of things. And it's always like this, right? If you are trying to put together an offering, is this your first offering? Is this your second offering? How many offerings have you done? If it's your first offering, you certainly should consider partnering with some people who can bring your credibility profile. And in general, people partner for a few reasons, right? One of them is history, track record, credibility. Other reasons is money, and other reasons is bankability, experience, and so on. But if you are relatively new to this, certainly try to find some good folks you could partner with, and at least piggyback a little bit on their history, and just understand what value you bring, so that they feel like they want to partner with you too. Hopefully, you can bring something to the table that they don't have, or something that they'll be comfortable partnering with you. On the other side, if you're looking to invest, boy, I mean, there's really no better way to think about investing. it's a three-step process, and always a three-step process. First is know, like, and trust people who you're going to invest with. Find a way to get to know them somehow. It may not be easy, but it may be. This is a critical step. You just can't bypass the step by reading fancy language. Have a conversation with them. Understand who they are. What are their core values? What they stand for? What their history? Are they high integrity people? Right? If you get to know them, that by far could beat everything else. And if you feel comfortable there, then you go into the deals. There are good operators, honest, high integrity, but they may be offering subpar deals. It is possible that they can't find good deals, and they want to do deals, but they just can't find them. So just watch out of what the deal itself. Just understand the deal and the business plan, and get very comfortable with that strategy and the execution. Once you go through that, the step number 3 is really the economics of the deal. Alignment of interest, like we talked about. Are the investors getting a fair shake of the deal versus the sponsor or the operator getting the bigger side of the upside? There is no right or wrong there. It really depends on the deal and the level of risk. If the deal has relatively high degree of risk, the investors need to capture relatively high degree of upside. Otherwise, they're not compensated for the risk they take. So it's not one answer to all these questions, but it's a combination of that. And sometimes investors can actually they can negotiate. So if you're an investor and you find a good operator, you find a good deal, and the terms are offered not necessarily the terms you like to see, you could actually talk to the operator and say, listen, I'd like to work with you, I'd like to invest with you, but I believe these terms are not necessarily what I would invest under. So we do this all the time. We'll come in and say, yeah, we'll invest in the deal, but we need improved terms. And there's two answers to that question, right? One is, if it's a good operator, a smart operator, they're going to say, how much capital you're looking to invest, and how much capital you plan to invest with us on other deals. Like, is it a relationship, or they're just trying to step on their toes? And if they get an understanding this is a repeat capital with more dollars to come, they may agree to a concept called sidecar. So from time to time, you as an investor can actually have a conversation and say, listen, I'm writing a $100K check, but I have another $1 million sitting and waiting. I might be writing into other deals, and I'd like to get a little bit better terms. The other answer, they're going to tell you, we can't change the terms. This is the terms, and this is a fair deal. Please understand, and I'll explain it to you. And once you understand, you can say, yeah, maybe this is this is reasonable. So the side deals you can get sometimes you cannot. And there's nothing fundamentally wrong, but asking the questions and trying to understand how they think and how they act. And do they also, some really good operators will say, yeah, I appreciate your interest, but I can't change the terms. These are really good terms, and this is why. And if you don't like the deal, it's okay. So some of these behaviors are really important to see. So there's no right or wrong, but it's more of you start developing good feeling. And what I like to find is operators who are really good at doing deals, and they're very poor at raising money. So this is what I look for, because we raise capital. And if somebody is a good operator and they know how to do deals and they're very good at this, and they're not very good capital raisers, these are the folks I want to invest with. The reverse is true. There are brilliant marketers that are just really good at delivering the message. Usually these folks are not good operators because they develop the talent being a marketer. And at times you see these partnerships. You have a good marketer with a good operator. And you can consider investing in the deal, but you really have to dig into the operator of the deal, not the marketer of the deal.
Good, Mike. Well, I wanted to say thank you for being on the show. For all of our viewers, this was episode number 110. We got Big Mike. He talked to us about investing in syndications and just different syndication structures. Went over different fees structures as well too. Mike, if somebody wanted to either invest with you or get in contact with you, what would be the best way to do that?
Really easy. Again, I go as a Big Mike, so that's the easy part. and I'm a fund manager. So just go to bigmikefund.com and you can find me. And my standard joke in these situations, if you forget the D at the end and you wind up at bigmikefund.com, I promise it's not a kinky site.
That's funny. Good, Mike. Well, once again, thank you so much for sharing your knowledge. I really appreciate you, and I am confident that we'll do more episodes. And I appreciate your expertise in this topic and many topics because I look at you as one of those people that really, really know what they're doing, and I appreciate you as a human being. So, thanks again, Mike, for being on the show.